Hello everyone, and welcome to this very special Global Data broadcast coming to you live from our offices in Dubai. My name is Sonia Kerrigan and I'll be supporting your interaction with this webinar, during which we're going to be diving into the ripple effects of the latest global shakeup, the US tariffs. Now, as we all know, on the 2nd of April, what some are calling Trump's Liberation Day, the world turned upside down. The global economic order was shaken, markets wobbled, oil prices dropped, and just like that, we were back in the world where the only certainty is uncertainty. Now, unsurprisingly, we've seen a sharp uptick in searches across global data's intelligence centres. The world is in turmoil, and tariffs are the biggest strategic issue that most of our clients are facing today. As a result, we've pulled together a task force of over 200 analysts and consultants who are ready to provide you with the perspective you need when it matters most. We've mobilised resources from across key areas to help our clients make sense of the current tariff environment. If you could go to the next slide, please, Colin. So first of all, our team of 30 economists are analysing the global impact, looking at how tariffs are reshaping capital markets, currencies, and the wider economic order. Second, we have 150 specialists tracking the implications across 20 industries, from construction and energy to aviation and manufacturing. So businesses like yours can understand what it means to your specific markets. Third, our data scientists are building you a new tariffs dashboard. Now it's launching imminently, and it's going to bring all of this to life through data visualizations and near real-time market signals. Finally, our 50 consultants are working directly with clients already to unpack specific challenges. So whether that's scenario planning, exposure mapping, or rethinking your supply chain strategy. Now, this session is part of Global Data's broader series, which will be delivered over the coming weeks and sits alongside our strategic intelligence platform, which is laden with data and actionable insights. Now, as I mentioned, searches across all of our databases are significantly up. And you'll all know that MEED is a wholly owned brand of global data. Here in the GCC and across our MEED platforms, we're seeing searches especially up around construction costs, supply chain, steel, and the impact of a weaker dollar on project viability. So today we're going to unpack what all of this actually means to our region specifically. Now, as most of you will know, the two people next to me are Ed James, who is Head of Content and Analysis at MEED, and Colin Foreman, Editor at MEED. Between them, Ed and Colin have spent decades providing their unique insights on disruption in this region, from oil shocks and trade shifts to the transformation we're seeing through Saudi Arabia's gigaproject agenda. We'll be taking your questions at the end. Do submit them as we go through. I'll be seeing them coming through over here in the Zoom Q&A box. The webinar is recorded, and in a couple of days you'll be able to watch it on our YouTube channel. We have a few slides that are going to support us through this. Colin, shall we start with the basics, please? What exactly are these tariffs and what's the rationale behind them?
Thank you, Sonia, and hello everybody, and welcome to the webinar again. I think where we really need to start off is perhaps 20 years ago that Donald Trump for many years has been saying that he's a big fan of tariffs. He thinks there's a trade imbalance as far as the US is concerned. He thinks that other countries are basically eating the US's lunch by sending products over that are unfair. So this is a belief he's had for a long time. In his previous administration, he talked about it, and it did cause some consternation in the markets. And it was very much part of his campaign when he was campaigning for another term as president. So it's been very well signaled. And then on the 2nd of April, he had what he called his Liberation Day, where he announced these tariffs, which caused a massive shock to the market, even though it was very well signaled for a very long time. So really was a key moment. And I think for myself personally and my colleagues, I think it really was one of those moments where you think this is a sort of a market defining moment that's going to really change what happens over the next few years. So other things that have happened in recent years would be the sort of March 2020 COVID-19 impact, where we had oil prices going negative in some cases. And then also things like the global financial crisis. And for this region, when the oil prices dropped in late 2014, that was another key moment. So it really did feel this is a pivotal moment for the global economy. And what was it that Trump said? Well, Trump said, look, I'm going to start to introduce new tariffs to try and correct this trade imbalance that he feels that the US has. And he has a few particular targets. China was the main one. There was others in there. The European Union, Vietnam, Taiwan were the sort of the top of the list when it came for the higher rates of tariffs. And there was a formula that he was using to calculate those tariffs that got talked about quite a lot, which didn't really fulfill the sort of what it was billed as a retaliation in terms of tariffs. It was more of a formula that was put there to just try and get some mechanism in terms of a tariff through. On top of that, I think it's also important to highlight that while this is something that's looking to correct a trade imbalance, it's also looking to raise revenues. The way a tariff works, just for the very basics, it means if somebody's importing a product into a country, they have to pay a fee or a certain amount of money to bring that product into the country, which is collected by the government. So in the case of what Trump's talking about, if you're a supplier from overseas and you want to bring a product into America to sell it, you'll have to give the government a certain amount of money, which is revenue for the government. And that helps the US government with, particularly with its issues with debt. So that's where we stand in terms of what's been going on. The situation's been very fluid. So he announced that raft of tariffs across the board on the 2nd of April. Then about a week later, he announced a pause, which applied to all countries except China, which seems to be the focus of his policy at the moment. And then he increased the tariffs to go on to China. So that's where we stand at the moment, but the situation is very fluid. As you can see on the slide, there's lots of products that are exempt. There's other products that have special tariffs applied to them. And then there's just been announcements just in the last couple of days about reviews on certain products as well. So the situation is really changing quite a lot in terms of some of those specialist things that are coming about. So I'll just move to the next slide. Before I get on to the MENA impact, I think the other thing which is important to talk about is we've talked there, well, I've talked there quite a lot about what Trump has done. China, from its side, has also announced a set of tariffs, and just in the last couple of days, it's been quite strategic in what it's been doing. So two things that China has quite a lot of control over is rare earths. At the moment, China controls about 62% of rare earth manufacturing and about 91% of the processing. This is quite important, rare earths, because they're used a lot in technological equipment and particularly IT applications, and does have an impact on the US defense industry as well. So what China's doing there is putting export controls on rare earths. This is a tactic that China's used before in the past. It's used it with, I think it was Japan previously. So it's a tactic they've used to great effect, and that could be quite difficult for the US going forward. And the other thing which China's talking about in terms of dealing with this trade war that's ongoing now is imposing tariffs on US services, which is moving the game a little bit, because the US actually has a surplus, a trade surplus with China when it comes to services. So that's some tactical maneuvers there by China in dealing with the US implementation of tariffs.
Have tariffs ever been put on services before?
I think they have, but I'm not sure of the exact details on that. If we then look at the impact on the MENA region, obviously the tariffs got introduced. We can there see on the table that there was a range of tariffs introduced across different countries. So as you can see there, Iraq, for example, had a 39% tariff, Algeria 30%, and Jordan 20%, whereas the markets in the Gulf that we tend to cover more actively, where there's a lot of project activity, it was the flat rate of 10%. Perhaps the important thing to talk about, which I know Ed is going to move to talk about shortly, is the impact on the oil price. We're obviously in a market that is particularly sensitive to oil price fluctuations. and we had a drop in the oil price once the announcement of tariffs came through. That was due to economic uncertainty, revised growth forecasts going forward, and the double whammy really of OPEC saying that they were going to increase production at the same time. So we're now in a lower oil price environment, and I know, Ed, you'll be talking about that when it comes to project activity. So that's really where we sit at the moment in terms of tariffs. A lot to talk about, very fluid situation, but I think the thing that's the most important thing to remember, it's very uncertain at the moment. There's this 90-day pause that Trump announced, I think it was on the 9th of April. While that did seem like it was good news, speaking to businesses and people in the region, the view on that is that while that has taken some pressure out of the story and the concerns, it means it's just prolonging some of the uncertainty. So in many ways, it's delaying investment decisions and moving ahead with some of the projects that are being planned. But we'll come on to that a little bit later.
Can I just ask, it's interesting to see here 10% flat for the GCC. Why do we get treated differently in the GCC?
Well, the US has a trade surplus with a lot of the GCC, and they just applied the flat 10%.
We'll see in a second.
Sorry.
Thank you, Colin. I'm now going to talk a little bit about the oil impact and its potential impact on the projects market in the region. But before we do so, I've got a quick question for everyone. And that is, what impact do you believe the imposition of US tariffs will have on the GCC economy and projects market? So will it have a negative impact, no impact, or positive impact? Let's see what you all say. And we have more than 3,000 registered attendees today. So we should get a fairly good sample size that will be representative of the market's view as a whole. Sonia, you've got
the answers are coming in thick and fast. Over 500 people have already answered. We're going to give it a little bit of time so that everyone can catch up. Assuming that it's on your screens at the moment, I'd urge you just to take a quick click and tell us what you think. Right, brilliant. We've reached nearly 100% answered, and to keep us moving, let's get those results up on the screen. 57% of people think that there will be a small negative impact. 21% is the next one, a major negative impact. 9% no impact, a small positive impact, 10%, and then a major positive impact is not a popular answer at just 2%.
Okay, well, one can always hope.
Well, indeed, yes.
So a vast majority of people believe it will have either a major negative impact or a small negative impact. So clearly there is a concern, at least amongst the viewers today, that this is certainly an issue of concern. So before we look at that oil price issue and the impact on the projects market, you asked a question earlier, Sonia, on why there was only 10% tariffs imposed on the GCC states. Well, as we know, we saw Iraq, Jordan, Syria, and Algeria had much higher ones. Well, the reason here is actually illustrated on these two tables here. The fact is that the US enjoys a surplus in terms of its trade balance with the majority of MENA states. That's because a lot of MENA countries don't actually produce that much, and if what they do produce tends to be directed much more to East Asia and Europe. So the US generally exports more to the region than it imports. And so given the fact that it's got this surplus, and given the fact that there are very few tariffs imposed on US imports into the region, that baseline 10% was deployed. And you can also see here that actually very small percentage of total exports from the region are directed to the US. In fact, only Bahrain exports more than 5% of its total production to the States. So actually, from a trade perspective, one can argue that there won't be a huge impact imposed by the tariffs. And you can also see that in many cases, the key exports to the US from the region are actually energy-based, oil and gas, petrochemicals, and so on, that actually are exempt from tariffs. So ostensibly from this sort of trade perspective, there isn't a huge amount to, I think, to concern the region. I think it's the other impacts, knock-on impacts from the tariffs that may be of greater impact and worry. And this is why, really. So one can argue that actually it's the impact on the oil prices that the oil price that is going to have the biggest impact, particularly on project spending in the region, which I know a lot of you are keen to learn more about. So we've seen a $10 a barrel fall since the tariffs were announced, from about $75 a barrel in terms of Brent crude prices to $65 a barrel as of a couple of days ago. Now, despite all the economic diversification the GCC states have undertaken over the last 2 decades, by and large, the region is still very dependent on oil revenues and therefore the oil price. And you can see on this table as well that in many cases, the budgets for each country in the region are predicated on oil prices which are higher than they are today. Only Oman, Qatar and the UAE are below this current threshold of $64 or $65 a barrel to make their budgets break even. So by extension, well, the result of this presumably would be lower government revenues. And we know from historically that also results in lower economic growth and dampens the economic fortunes of the region. So when looking at the tariff issue in the GCC, it might not be a case necessarily of the impact on trade, but more about the impact on the oil price.
There was one point on your previous slide around FTAs.
Oh, yes, right. That's a good point. Thank you, Sonia. So actually, there are a number of countries in the region that have free trade agreements with the US, Bahrain, Oman, Jordan, and Morocco. And those are among some 20 countries globally which have free trade agreements. And free trade agreements imply that there should be zero tariffs, both in terms of imports and exports between the relevant countries and the US. And indeed, the US imposition of tariffs breaks both the WTO rules, which it's a member, and these free trade agreements. And to get around that, Trump has used a 1977 law, which states that in the case of an emergency or security emergency or national emergency, the US can impose tariffs on imports. So this is how he's got round these WTO rules and these free trade agreements. So we'll wait and see just how this will pan out, because clearly these countries will take this to the WTO and various different courts of arbitration to protest that.
It's a legal issue as well as a diplomatic.
Down the road, yes, yeah. But the US Trump would say that they're on pretty firm legal grounds for doing this, citing the trade imbalance as a national emergency.
Right. And when is down the road?
Well, these things take a long time. You've got to prepare the cases. You know, these trade courts can take many years. You have the original case arbitration, then you have the appeals process. It's not something that's likely to impact this in the short term.
Okay, so it's not like the 90-day thing.
No.
Okay. So I think it's time to get our audience involved again. There was another poll.
Yes, let's see if you've already been impacted by the tariffs.
Okay, so once again, we're going to ask you to participate with us. Again, the volume of people on this means that we're actually going to get fairly meaningful results. So thank you to you all for attending. As I said, this is recorded. The questions are coming in thick and fast, Ed. I think we're going to be quite overwhelmed. Anyone that has a question submitted, if we're unable to answer it, which quite frankly, in a lot of cases we're going to be, we will look at them all and we will get back to you where we're able to, or perhaps even host another broadcast. Okay, so we're at 52%. Please click. Okay, and I'm seeing actually there's a front runner. It's had no impact, but we expect it will. So that's the only certainty is uncertainty is obviously prevailing. And at the back end of it, yes, it's already had a major impact. I think we're nearly there. So if we could see the results overall, as I said, number one is it's had no impact, but we expect it. Number two is, yes, already a minor impact. So I'll be quite interested to hear from you at a later date. And then very close together, no impact and we don't expect it. Yes, it's already had a major impact.
Okay, well, clearly there's a lot of worry, and it's already having a direct effect on you all here today and your companies. And indeed, if you, for those of you who've said it's already had a major impact, please feel free to write what that impact is in that Q&A box, and maybe we can read it out and hear your thoughts on that directly. Right. Sonia, do you want to just repeat what you said earlier?
Yeah, so as we said, we are very much here to support you. We have this tranche of global data and MEED analysts here ready to react. And moreover, we are creating a series of strategic insight intelligence centres, reports, and then also, of course, our analysts and consultants are accessible to you in exactly the same way as both Ed and Colin are today to help answer your questions. I'll say it again later, but anyone who's watching this now will receive a call from a member of our team. We very much believe in being proactive. That's why we're here doing this today, and we will continue to be proactive with you. You don't need to come to us. Our team are going to call you. We're very aware we're coming into Easter, that tomorrow is not a working day for many people watching us. So we'll be very empathetic to working hours and holidays, but we're going to call you and we're going to see if we can help you in any other way. That's all I needed to say there. Thank you.
Well, I mean, the strategic intelligence from global data is extremely insightful. I use it all the time to understand what's happening both in the region and globally and across different markets and sectors. So it's definitely something that many of you would benefit from. All right, moving on. If you don't mind.
Sorry. There we go.
There we are. So we were talking about the oil price fall, and not only could that have a potential impact on the wider macroeconomic situation in the region and its outlook, but in terms specifically of the performance of the projects market, there could also be quite a big impact. Now, this graph here correlates or shows project contract awards over the last 10 years against the oil prices. And we saw oil at above $100 a barrel between about 2012 to 2014. And that's when we last had record spending in the region. We had about $170 billion of contracts awarded in 2013, 14 and 15. And when the oil prices started to fall very sharply, actually, at the end of 2014, then we saw a big fall also in contract spending, which you can see here. There was a very much more muted and quieter projects market between 2016 and 2022 when the oil prices declined. No surprise why. Governments earn less revenues and therefore they spend much less on their capital projects program. And that's because most projects in the region, by and large, are funded directly from government budgets and by the state. On the other hand, you can also see as oil prices started to rise in 2021, 2022, then that translated also to a very sharp increase in project spending in 2023 and 24. New records, in fact, never before seen levels of expenditure. So yes, there are government policies, there are economic diversification programs, there are other giga projects, but still, by and large, the projects market in the region is predicated on the oil price. And that's why when that oil price falls, as it has done to about $65 a barrel, then there is rightfully a lot of concern around the projects market outlook and project spending overall. And I think, Colin, one of the things that you've noticed and touched on is this lag between the fall in oil prices and actual project spending.
Yeah, and there's a few things to unpick there. So there's the issue that once you've got a declining budget or government budgets come under pressure, how that filters through into project spending takes time. That seems to take about a year depending on the market. Some markets traditionally have been more responsive to the oil price than others. So the Saudi market and the Kuwait market, for example, have traditionally been very responsive to an oil price, whereas the UAE, which is in previous data, sort of oil price slumps, being a bit more diversified, that lag hasn't been so noticeable. I think the other thing to add to that is that we're talking there very much about contract awards rather than ongoing project activity. Of course, projects that have already been contracted and have people on site working tend not to be demobilized and stopped. There are examples where projects do get stopped halfway through, but by and large, projects do tend to continue. What often happens in that case is that maybe timelines get stretched, completion dates get extended, as governments look to sort of curb their sort of monthly spending, as it were, in terms of bills on sites. So that lag plays out in a couple of ways. And then on the other side, just to quickly mention it, the time lag when oil prices go up is also there as well. So once a government decides to start spending more money on projects, it takes time for projects to be approved, designed, tendered, and move into construction. So you do have that time lag phenomenon going on there.
And I think also for state-funded projects as well, the budgets have already been allocated. So it tends to be a bit more independent of the oil price direction.
Yes.
And I also expect that there'll be greater reprioritization on the essential projects, such as the event-driven ones like the World Cup, the Riyadh Expo in 2030 as well. These are the ones that can be even more prioritized than others.
Yes, from the previous 2014 downturn, we found that the two markets that really continued the strongest, let's say in 2015, 16 and 17, were the Dubai market, which was preparing for Expo 2020, and Qatar, which was preparing for World Cup 2022. I think you make another good point there about government infrastructure projects. I mean, a government does want to curb some of its spending when it has a budgetary concern due to a drop in oil price, but at the same time, a government still has to go about the business of providing goods and services, providing services for its population. And a lot of things like social infrastructure generally do continue during a downturn, as they're very mindful that they do have to keep providing services for people.
Yeah, that's a good point. And the governments don't have any choice. They have to invest in power, water projects, social infrastructure, as you say, hospitals, schools, and so on, especially if the population continues to grow.
If I can add, I think there's a few other differences this time around to, say, 2014. 2014, as I mentioned, the Kuwait market and the Saudi market were very responsive to a drop in oil price. The political dynamics were also very different. So in Saudi Arabia, you had a new leadership coming in at the beginning of 2015, and they were really reassessing spending and looking where there'd been inefficiencies in the past. And if you remember, there was that review of capital expenditure projects and things going on. This time around, there's no change in the political direction. There's very much a commitment to diversifying the Saudi economy. There's Vision 2030. There's all the giga projects, and they have very strong backing from the leadership. So I think the political dimension's also quite important there, particularly when it comes to Saudi Arabia.
Yeah. And another thing I think is worth mentioning is that actually oil and gas expenditure tends to be fairly resilient to the oil price, somewhat ironically, a lot of the time, because during times of lower oil prices or slower global economic growth, commodities prices are also lower. So it actually becomes cheaper to award EPC contracts than it would be during the times of greater supply pressure for some key materials.
I think you're right there. Yes, ironic, but I think also logical. So if you think about where we sit today, we've got OPEC Plus talking about increasing production levels. You've now got oil companies that now are looking to increase production. So they'll need to spend on existing fields, maintain production, possibly even increase production. So field development should still go ahead, and there's an expectation that will. At the same time, the gas market, there's a strong drive to increase the amount of gas that's produced in the region. So those projects should continue. And also the petrochemical space is quite strong. The feeling, when speaking on the oil and gas space, that the projects that may come under some pressure are those that are sort of the more ESG related, environmental.
Carbon capture, carbon storage.
Yeah, exactly.
Now, I know these two well enough to know that this will go on, and I need to just keep you on time. So I wonder if you could just move into the construction.
We can talk all day. We can talk all day, and often actually do.
The questions are coming through.
Yeah. Okay. Yes. Absolutely. One last thing I'd like to say: PPP when governments come under pressure, PPPs may well become more popular as a means of financing projects, and that's certainly something we've seen. Now, I wanted to touch on the contracting and project services side of the issues around tariffs. I want to now also start focusing on China. Of course, China and the US are having the biggest sort of blows right now in terms of the tariffs, with both imposing more than 100% tariffs on each other. And I think it's worth looking at China and the US and how they are, and their impact on the projects market and their involvement in the projects market, the GCC in particular. This graph on the left shows that Chinese contractors have begun to dominate the GCC projects market. Last year, $90 billion of all contracts in the region, that's 90 billion out of about 265 billion, were awarded to Chinese contractors. And they're by far the largest contingent of international contractors active in the region. You can see how that has shot up over the last couple of years. And I think that's very interesting because it's helped pivot the GCC projects market much more to China and East Asia over the last 18, 24 months. So there are actually very few US contractors active in the market these days, and where they are is when they are active, it's in the EPCM space. But US companies dominate the services market. That's engineering, consulting, PMC, architectural space. And indeed, you can see here that when you compare with China, 98% of all work between the Chinese and American companies, the US has 98% of the project service work. So the Chinese dominate in contracting, the US dominates in project services. Of course, services exempt from tariffs. Now, the other thing I think we need to look at is FDI into the region, and comparing US FDI and Chinese FDI. And when I'm talking about FDI here, I'm talking about FDI into greenfield projects like petrochemical facilities, refineries, food manufacturing, steel manufacturing, green hydrogen, and so on. Now, I think it's worth mentioning that the GCC is very competitive when it comes to energy intensive industries, obviously very low cost power, lots of space to build on, and very cheap energy, water, electricity, and so on. For that gives the region a big cost advantage, a competitive cost advantage against production elsewhere. And again, we can see that China, thanks to its Belt and Road Initiative, thanks to a geopolitical push into the region, has now again really begun to dominate FDI. And 2024 was a key year. We've seen more than $18 billion of investment from China into the GCC projects market. And of course, when you're talking about FDI and projects, that's the biggest chunk of FDI generally. So again, that's helping the region pivot much more to China and reducing that reliance on the US. And indeed, when you take that pipeline of known future FDI as well, you can see that China has more than double the US planned FDI investment. And that 2024 picture looks like it's going to continue going into 25, 26. Again, that helps isolate or insulate the GCC from this tariff situation, and has resulted in a reduced reliance on US FDI into the region, although it's still fairly significant. Now, also, I think it's important to look at construction costs, construction availability, and materials. And here again, I want to compare China and the US in terms of key construction materials. Now, here I've taken all the value of all imports from the US and China into the region, plus Jordan, Iraq, and Egypt, in terms of those key products that impact construction projects directly and have the biggest impact on net costs. And you'll see here, when you're taking the different products based on their HS codes, you can see that China imports into the GCC, Jordan, Iraq, and Egypt about $43 billion annually, or last year anyway, of these goods into the region, while the US imported last year about $10 billion. So 5 times more nearly between China and USA there. So again, that would suggest that the exposure to any counter reciprocal tariffs imposed on the US into the region would be more mooted, given that the Chinese are filling up that gap and may well do so should those counter-reciprocal tariffs be imposed. So it's clear again that the region is shifting much more to Asia and China in particular when it comes to any required imports of equipment and material. Where the US tends to be very strong is in machinery, boilers, nuclear reactors, pressure vessels, turbines, and so on. But otherwise, you can see here that the Chinese have a big lead in terms of imports into the region.
With the exception of machinery, could all of those USA numbers move over to Southeast Asia?
Yes, so if you consider now that all these Chinese products and equipment are going to stop exporting to the US because of this massive 145% tariff, they're going to try and look for other markets to invest in. And of course, the GCC has very low tariffs. There's a geopolitical dimension to it. There's strong FDI from China. So as a consequence, there's going to be China going to be targeting a lot of the region for redirecting some of these products. And that's going to push down prices most likely. So yes, there are a lot of fears around cost inflation and so on, but taking a look at the data and taking a look at this surplus Chinese materials and output.
Is that not a good thing for our market?
Yes.
I
I mean, if that's what happens, then of course, yes, it'll make projects cheaper to build.
I think the important thing to add here is that the US products that come into the projects traditionally, the stronger area for US companies are where they're specified. So the items that are specified tend to be critical components. So as Ed said, things like boilers and highly critical pieces of machinery, they tend to be specified from a US manufacturer and can really only be acquired from certain places. China tends not to be as strong in that space. That is changing, but at the moment, those critical pieces of equipment tend to come from the US. Where that could become interesting is if you have manufacturers in the US that say go out of business because they've lost orders in China due to trade war, that may no longer be available. So that can change also, but I think that specified angle is quite important to remember in terms of what comes from the US into the region.
The higher technology space.
Yeah, exactly.
And things like plastics, petrochemicals, technology, and licensing, and so on. Yeah, absolutely.
So the GCC is really good at turning a crisis into an advantage. Is this one of those moments?
Yes, potentially. You see, even if there's a 10% baseline tariff, which is the original position of the US onto the GCC, and is likely to be, even after the 90-day pause, if they don't go back to that pre-2nd of April number, it's going to be 10%. And so many countries which are going to have higher tariffs imposed on them are going to be looking at other markets where they can build a production base to benefit from that lower tariffs into the US. And of course, the GCC is well positioned for that, especially in those energy intensive industries. So over the long run, and it takes many years for this to happen, because of course, investments take a long time to be built, decisions to be made about them, financing and so on. Over the long run, yes, it's very possible that actually it stimulates investment into the region. Also, of course, you have UAE as a big re-export hub, using the free zones and trying to direct traffic through there. That could also flow through to the US. So it's a difficult one, and we're still very early into this process. There's still a lot of uncertainty, but in some ways, the region could benefit from this. Outside of the oil price, of course, but
yeah. So I'm thinking we've done roadshows with Red Sea, with Real Medina, looking for supply chains like the ones you've just put on the board. And I imagine that some of the teams that we've worked with would be anticipating some success out of this. That's what I'm thinking.
I don't know at this stage whether that's too early. Of course, a lot of materials now are produced in the region itself. Things like cement, some steel, and some ceramic type materials are produced in the region. So there's a lot of that which won't be impacted. But I think the global economic uncertainty might have on tourism numbers, it might have on the oil price and GDP growth will probably be more at the forefront right now than the construction materials and availability, because we have to wait and see how that goes.
I think one of the important things to consider there, and it's a good question that you asked, Sonia, about turning it to an advantage. I think The crisis at the moment for the rest of the world is very much a crisis. I think we've seen from the poll results that at the moment it's not really crisis level here at the moment. People are expecting some issue, but they at the same time they're not expecting it to be major. So I think in relative terms, I think the region will be spared some of the economic pain that's being felt elsewhere in the world. And as a result of that, that will put them in a stronger position going forward than other places that have to deal with some of those very real severe consequences. So although it's not obviously an advantage at the moment, with the fullness of time in relative terms, it could be an advantage for them.
Yeah. I just put everything into a summary here. I don't think I will go through it all due to the large number of questions we've got. How many have we got, Sonia? More than 100?
Over 100.
Over 100, right. Well, we're going to have we'll have half our lives cut here now answering these questions, Colin. But as you can see, this stress basically summarizes everything that we've gone through here. And I think there's a lot of things to talk about, a lot of things we probably haven't had time to touch on, maybe some things we haven't thought about. So I think it would be now opportune to go through to the questions, Sonia, and get your views and thoughts from everyone in attendance today.
So there's a build on what we were just saying about, around it possibly being an advantage. How quickly or if at all do you see reduction in prices of Chinese and European products?
Yeah, I mean, it's a good point as well. Of course, we're talking about China, but Europe is also going to have tariffs, is having tariffs imposed on them. So again, the GCC with its very substantial capital expenditure drive on projects could well become a target for a lot of exporters from around the world. And yeah, the result of that could be much lower construction material costs, greater FDI. But I think it's a little bit too early to say as well. So this is all hypothesis, conjecture right now. And things can change a lot. Yeah, I mean, Trump could wake up tomorrow and decide that he wants to revert back to that 0%. So we'll see.
Okay, on your services point, so services are diverse and it crosses borders using different modes. So how can you put a tariff on a service? Where is it going to get collected? I don't know if we're going to know the answer.
Well, tariffs are exempt for services are exempt from tariffs.
Services are tariffed.
They won't be. They can't. It's very difficult to. I mean, traditionally services aren't tariffed because the nature of the work and effectively nothing is really exported. I mean,
the usual way of controlling services, though, and putting protectionism in is things, and we see this regularly in the region, that you have to have a local office, you have to have a certain number of people working in the country. Headquarters have to be located in certain places. There are ways of introducing protectionism into services.
Yeah, and of course that's by and large already implemented in the region in local content.
Okay. Do you foresee Chinese companies relocating to GCC countries with free trade agreements with the US?
Well, they already are. And as we've seen, having a free trade agreement doesn't protect you at all from US tariffs. But Chinese have come in very strongly into the region, both in terms of contracting, material supply, and FDI. So I expect to see that potentially accelerate.
Okay. Any views specifically by the PIF, ADIA, Aramco on the same?
Yeah, I think one thing to note just in the background of all this, I think a lot of what's been going on in the last couple of months have been pressures that we've been feeling already with in terms of budget spending. Saudi Arabia has been talking about this reprioritization of projects for well over a year, and obviously that noise has picked up since there's been a drop in oil price. So I don't think we're seeing a change in the direction of travel. It's just catalyzing or enhancing or turbocharging that conversation a little bit at the moment. From our point of view, what we've seen in the Saudi market in terms of PIF activity, spending on giga projects was down last year when compared to 2023, and the expectation is that it will stay about flat this year when compared to last year. We are seeing priority projects and priorities emerging, so things like the World Cup in Saudi Arabia that will still be pushed through. So I think it's just going to continue the ongoing trend.
So there's a question there on which projects are most susceptible. You've mentioned infrastructure, critical infrastructure going ahead. We've mentioned the time-bound events projects. Is there kind of a firmographic or a a project stage perhaps that makes a project susceptible to?
I think where the conversation becomes very difficult for a project that's going ahead is a new master plan scheme where you have to invest heavy infrastructure that has very little return in the near term. And there's quite a lot of things at that sort of stage, particularly in Saudi Arabia at the moment. In the UAE, it's interesting. In the UAE, a lot of the construction work now is smaller projects completing existing master plans that have already had that infrastructure investment gone through. In Saudi Arabia, it's different. There's a lot of upfront infrastructure investment that needs to be done. And I think that's the difficult investment to get over the line, because it's a large sum of money with very little return in the near term. But there is a return in the long term. But that's where you would think that's where the spending will be cut.
Real estate and tourism projects, I think, also
Resilient?
No, I think the opposite. I think could come under pressure if macroeconomic growth slows.
Okay. On that, so there's I don't think we've discussed it really. Lowering of US exchange rates will weaken GCC currencies and make it expensive to trade with Europe and others. What do you think?
Well, as we know, all the GCC currencies, except Kuwait, are tied to the dollar. So when the dollar decreases in value, so does the currencies in the region. And also when the US raises or lowers interest rates, so do the GCCs and GCC central banks in tandem. So yes, a weaker US dollar will make it more expensive to import, but also at the same time will make it cheaper to export as well. And on the other hand, we may well see the dollar strengthen. Again, it's up and down at the moment, so it could go either way.
Another attendee kind of builds on that, talking about, will that create an inflation in GCC?
Macroeconomically, I mean, macroeconomically, yes. I mean, more expensive imports would translate. But when it comes to construction materials or project costs, then we may see the opposite.
90-day temporary pause on Trump's tariffs. And again, I appreciate that you're completely hypothesizing, but this user asks, what's the likely outcome? What's going to happen next?
Well, I think for the GCC, the baseline beforehand was 10%. After 90 days, if tariffs policies continue, it will remain 10%. I mean, the US has a trade surplus with the GCC, so it doesn't make necessarily sense for those tariffs to be any higher. The question is, would reciprocal tariffs be applied to US imports?
So you mentioned real estate. Could you elaborate on what you see could happen, particularly, after Russia, Ukraine? There was a huge benefit, particularly in the UAE, on the real estate market. Do you see this having an impact?
Yeah, I mean, the view that's being put forward that I've read a few times is that you're going to have softening interest rates, and that's going to benefit the property market. I think while that does hold firm in terms of making sense, I think the important difference is that in February 2022, you saw a property market at a very different stage in the cycle. You had a market that I think was still emerging from the sort of COVID-19 downturn, and it was still offering strong growth opportunities. A lot of people in town are now calling the market at reaching saturation. We had property prices drop in January. They did rebound in February. It feels like the market is approaching a peak, whereas in February 2022, that certainly wasn't the case. So I think it's in a very different stage of the cycle this time around. So while I do think that there could be some benefits, I think it's important just to remember where you sit on the cycle.
Yeah, and it's obviously dependent on the oil price, macroeconomic conditions, geopolitical conditions as well. And of course, in the market, Saudi Arabia is a very different picture to Dubai and Abu Dhabi.
Another real estate one. Will this lead to Saudi opening real estate to non-GCC nationals to raise finances?
That's something that's been around for a while. I was at Cityscape in Riyadh in 2023, and I was told that was coming through imminently by a number of developers, and still hasn't come through. I think that's something that's obviously long awaited. It's over a year now since I was told that. So that's an expectation that's been there for a while. possibly the economic uncertainty that's going on at the moment might hasten that decision, but it's very difficult to tell.
They have to get rid of the shortfall in housing for Saudi nationals first before they can start doing that. But it is the ace up their Saudi sleeve in terms of stimulating economic growth.
Okay, so with more pressure on movement of people, immigration across the globe, more so in the USA post-Trump, can we expect more people into this region, which means more consumption?
Yeah, I think that's a fair point. I think we've seen that certainly in Dubai, we've seen a great influx of people over the last 3 years from all parts of the world. So obviously there was people from Russia and Ukraine due to the conflict there, but you're seeing also for sort of further afield places like South America. A lot of people from South America are now coming into Dubai to live and work, and you're seeing a lot of people finding that it's a favourable place to live and do business.
I'm keen to know, Sonia, if any of the attendees today, the viewers, have put in any examples of the situation that's affected them directly and their company.
Yes, they have. I've just skimmed past. This is from an air conditioning company. We are not directly importing products from the USA, but from Italy. There is possibility of its impact as in case of our manufacturing company uses any materials which they are importing from the USA. So it's the long supply chain. Share price has dropped, so it's had a major impact on our company's stock price, which has dropped tremendously due to the economic concerns. Impact is mainly because we have materials manufactured in China that are usually imported into the US.
Yeah, I think that comment and also the air conditioner comment are really important ones, because what that's saying is, and we tend to not think about this quite so much, but supply chains are hugely complex nowadays. So you can have components coming from China being shipped into the US, then assembled in the US, and then maybe being shipped to Europe before being shipped here. It's a very intricate web, and if you start applying charges and tariffs at different stages of that process, it's quite easy to derail what's quite a complex supply chain nowadays. And that's obviously going to have an impact across the whole global economy, and construction's very much a part of that.
Too many acronyms. What is EPCM, please? Valid.
Engineering, procurement and construction management.
Okay, so this question, Trump wants to force countries to stop dealing with China or limit its trade. Is this about picking sides?
Does it? I don't know if these tariffs are about limiting, limiting Chinese exports to other countries. If anything, it's going to have the opposite effect. From what we can see, I mean, if the Chinese manufacturers can no longer export to the US, they're going to look at other markets. So it's only going to drive Chinese exports globally to other markets away from the US.
I think you're seeing a little bit of that now, particularly in the Far East, in terms of picking sides. But I think this region has shown that it's been very adept in recent years at not picking sides and remaining neutral and being very business friendly and open to everybody. So I think that picking sides conversation, I think the region will probably do quite a good job of not doing that.
Great. GCC, especially KSA and UAE, are focused on AI projects. Are tariffs going to affect these initiatives?
Only to the extent that there are tariffs on chips, microchips, and we've seen Nvidia already be saying it's going to lose $5.5 billion as a result of some of these the import of tariffs on imports of chips into the US. So potentially, in terms of processing storage capacity for AI, yes, but the region has been driving data center capacity anyway into the region recently, and but it would be interesting to see how that affects the likes of major data center providers like Google, Amazon Web Services, Oracle, and so on, and the impact it has there. But a lot of that services. So But in terms of the chips themselves and storage capacity servers, there could, yeah, I mean, there could be an impact, but it's going to take a while to unwind everything. It's a hugely, as Colin said, hugely complex, long supply chain.
Is China going to dump all its steel here?
I don't know.
Could you get out your crystal ball and just sort this one out for us? Okay, so the questions are flying in. They're actually in sort of subject matter clusters.
Okay.
Someone has asked if we could share the answers to them all. I think there are some kind of challenges in that, but maybe we could pull all the questions together and create some thematic answers. And I know absolutely, obviously.
We've recorded the questions, so we can have a stab at answering them all. And of course, this is being recorded, so you'll be able to listen again if we've answered something of interest. And we've still got some time to answer more.
Yeah, exactly. Okay, so given the upcoming Trump visit to KSA, do you think some relaxation deals might occur?
Well, the Trump regime, Trump has always been quite close to Saudi Arabia. The fact that it's one of his first overseas visits is quite significant. Saudi Arabia ultimately is the major arbiter of the oil price globally. And that is something that the US is still highly sensitive to. Yes, it doesn't import directly much crude or energy products from the region, but is historically stayed very friendly to Saudi Arabia because of its influence in those energy sectors, and also because of its geopolitical influence. And of course, it's a very sensitive area. So, of all countries out there, Saudi Arabia is one of the most favoured ones. So, what I would expect the US and Trump to go fairly gently. Certainly not treat it like it has treated China or Vietnam or even the EU.
Okay. Surely the dollar tanking is a far more serious problem for the GCC than anything else.
Well, yes. I mean, yes and no. As I said, imports become more expensive, but exports become cheaper. Yes, of course, oil revenues also are affected by low oil price, given that oil is priced in dollars. But I think it's important to wait and see whether the dollar is going to weaken. Some days it's going up, others down. So I think it's too early to say.
Okay, so the potential domino effect whereby the EU may raise its own tariff quota barriers to goods, metal imports to prevent redirection from the USA could impact Mediterranean-facing MENA exporters. Many have FTAs with the EU, but as noted for the USA, FTAs get overridden by safeguard-type trade measures. Does the MEED team have some intelligence as to what may be the degree of gravity of the outcomes for these Mediterranean-facing MENA countries?
I'm not sure exactly.
I guess they're talking about Algeria and Egypt exports, gas, textiles,
automobiles.
You mentioned when we were planning for this about aviation.
Yeah.
And you talked about the impact on aviation.
We haven't touched on aviation, and I know, Colin, you've got a few thoughts on that, but this is one area where the Chinese are not don't have much presence in the region. Of course, Boeing in the US does, as well as some of the Pratt & Whitney, GE engines as well, of course, core components of aviation. So maybe it plays into Airbus's hand, Colin.
Yeah, well, I mean, you've already seen China's targeted Boeing specifically, haven't they? Which has caused Boeing problems. I think if you were not from China and looking to secure a deal from Boeing or looking to get an order from Boeing at the moment, it's probably a favourable time to buy a Boeing. At the same time, Airbus has got issues in terms of selling into the US, so they might prioritise orders to elsewhere in the world. And let's not forget that in this region now, we're home to several very large airlines that acquire a large number of aircraft, so they will probably move up the queue in terms of priority for both Boeing and Airbus, given what's going on at the moment.
Can I just also touch upon a previous question about lower dollar and its impact? Critically, that will make real estate cheaper in the region for people buying from overseas. And that, I think, is a very important factor because it could well result in a big increase in investment in real estate.
Which plays to the fact that we've already got lots of people coming in anyway. So
It's a critical component of the project market in the region.
Yeah, absolutely. What does there are funding questions. So obviously with lower oil prices, less funding for even the critical infrastructure. Do you see escalation in PPP and other funding models?
Yeah, I think I already mentioned that interest rates might fall as well, which make financing less costly too. But there'll be more project financing, a lot more different mechanisms to try and raise financing. And indeed, actually, I think we had a poll question, Sonia, a third poll question, actually touching on that very topic. There was a third poll question. If we could maybe
dropped out of the presentation, to be honest with you there, Ed.
Okay.
There's a question around the benefit for the region's oil exporters if importers that typically get their petroleum from the US turn to the Middle East.
Well, I don't know. I mean, oil and gas is exempt from tariffs, and of course, it's not that easy to just simply change sources of oils, especially if it's delivered by oil and pipelines. Or LNG import facilities and so on, but I don't think that will change too much. Except in the GCC may start signing longer term agreements or directing more oil and gas towards certain markets to which it can now consider more important, for example, on a geopolitical basis.
So, given new circumstances and the fact that you've been tracking contracts awarded for most of your life, what do you expect for the rest of 2025 and 2026?
I think it would. We've seen it again on the poll questions. I think uncertainty will continue to be the dominant force, and the impact of uncertainty will be delays in decisions and delays in investment decisions and contract signings. So I don't think we're necessarily going to see things stopping, but we will see delays in decisions, and that means we'll see a reduction in certainly the levels of contract awards that we've experienced in the last 1, possibly 2 years. Would you agree with that, Ed?
Yeah, I mean, the market was indicating that it was going to slow a little bit anyway, but these tariffs could work in both ways. So in the short term, probably won't, in my opinion, have a massive impact this year anyway, especially given that a lot of these projects are driven by national visions and should be separate from any global macroeconomic issues. They've got their own internal drivers. But again, we have to wait and see.
There's been a lot of Q&A there. Let's get the final opinion of our audience. You're absolutely right, there is a third poll. So we'll put the question up for you now. If you could please answer, in which one area do you believe US tariffs will have the biggest negative impact on the GCC projects market? Oh, we're not getting a clear front runner in quite the same way as we did the other ones. So government spending is nudging ahead as the 1,000 or so people respond. Cost inflation is not far behind. Then logistics and shipping, which is still going backwards and forwards with equipment and material availability. We're just getting up to full participation.
So it seems to be related to that oil price issue and government spending, essentially.
Yeah.
As well as, of course, direct construction.
It's just not as clear cut as the other polls.
No.
So if we just pop the results up now for everyone to see them, you'll see it is 36% for government spending, 23% for cost inflation, 16% for logistics and shipping, and 15% for equipment and material availability, 5% for financing, and 4% think no impact. So,
Would we have predicted that, Ed? I think we'd have maybe guessed that.
Yeah, I mean, I think we said the biggest impact might be on that oil price and knock-on impact for government spending. Yeah.
So I think what's clear is that businesses are looking for clarity, and we hope that today's session has helped frame some of the key themes and things to watch. Thank you so much for your contributions, and also thank you to everyone in the audience who has asked questions. We are here to support the global data and MEED teams working across 20 sectors. So although we've very much gone into the GCC construction and projects market, we are here globally, and we will help you to track, analyse and respond to whatever comes next. Now, as I said earlier, we believe in being proactive. So normally on our webinars, we ask you to scan a QR code, or we ask you to tell us if you'd like us to get in touch. In this case, we're just going to get in touch with you. So you can expect a call today. International audiences, we will be empathetic to your working hours and your holidays. And thank you again, Ed and Colin, for sharing your experiences. Don't forget to join us next week for the Russian Project Showcase, when we're going to do a deep dive into what's going on there. And also, Ed and Colin are committed to talking to everyone that attends our Saudi Giga Project Summit in May about the impact of tariffs specifically with those key stakeholders. Thank you everyone for joining us, and we'll speak to you very soon. Thank you.
Thank you.